There's a lot of doom and gloom talk in commercial real estate right now, and with the speed of interest rate increases we've seen and the fundamentals starting to weaken in many commercial real estate asset classes, a lot of these concerns are rightfully placed. But if we are heading into the worst of a market downturn, this is also going to result in some of the biggest opportunities that we've seen in the last 15 years in this industry, and there are some really interesting avenues that I see opening up over the next 12 to 18 months for both investors and industry professionals that want to get ahead. So to share my thoughts on a few paths that you might want to look into if you're trying to take your career to the next level or you're just trying to find profitable deals in this market, in this video, let's walk through 3 of the biggest opportunities that I see in commercial real estate today and how you might be able to capitalize on these changes. So the first opportunity on this list has made a lot of headlines over the last few months, and this is distress in the office sector, specifically in major gateway markets. In the first half of this year, a handful of some of the biggest private equity firms in the world have defaulted on loans on some huge office properties located in some of the biggest cities in the country or listed these assets at fire sale pricing. In February, Brookfield defaulted on 2 office towers in downtown Los Angeles with an aggregate loan value of $755 million. Columbia Property Trust defaulted on a $1.7 billion loan on a 7-property office portfolio, including multiple office buildings in Manhattan, and Clarion Partners listed an office tower in downtown San Francisco earlier this year at $55 million, representing an almost 50% drop in value from the $107 million price tag they paid for the property back in 2014. And with the gap that we're seeing right now between office tenant demand and existing office supply, this is very likely only the beginning of the distress we're going to see in this sector, but many of these buildings are also some of the most well-located pieces of real estate throughout the entire country, which presents a huge opportunity for adaptive reuse. Many companies are already preparing for this, with Silverstein Properties announcing a $1.5 billion fundraise to convert functionally obsolete office properties into apartment buildings in New York, GFP announcing the conversion of a 22-story office building in the city into more than 1,300 apartment units, making this the biggest conversion in the country to date, and even the city of Pittsburgh now accepting applications from developers for city-funded loans to help pay for these conversions. All of this activity is inevitably going to lead to companies needing to hire talent that can help make these projects happen, including people that understand the development process, people that understand the nuances of the specific product type that each company is trying to build, and people that can communicate the vision of these adaptive reuse plays to equity investors and partners that can fund these deals. Now, in addition to capitalizing on the distress we're seeing in the office sector, there are also signs right now pointing to additional coming distress in a product type that's generally thought of as having significantly better underlying fundamentals, and this is distress in the multifamily sector, specifically as a result of interest rate increases on floating rate loans. Between about 2011 and 2021, in the vast majority of markets, multifamily investors could have made money essentially buying anything during this time, which has led to a lot of inexperienced and undisciplined sponsors being able to raise significant amounts of capital and buying apartment deals over the last several years with a significant amount of leverage that's now coming due. Many of these investors finance their deals with short-term floating rate debt at extremely high LTV ratios, which worked really well for a long period of time, but in 2022 and 2023, with the speed of interest rate hikes that we saw, debt service payments on these loans increased materially for these borrowers. And in the past few years, with multifamily properties in many markets being purchased at cap rates in the low 4% or even 3% range, the net operating incomes of these properties just can't support these new debt service payments, many of which have more than doubled in the last 18 months, resulting in many of these investors now holding on to properties that are losing money every single month. And since many of these short-term floating rate loans are only on 2 or 3-year terms, we're going to start to see a lot of loan maturities towards the end of this year or in 2024, requiring these investors to either refinance in a very different interest rate environment, likely at a much lower valuation and a lower LTV ratio, which is going to result in these investors being forced to either raise additional capital from their investor base to cover the outstanding loan payoff or sell these properties at a loss if their investors just want out. This combination of factors is going to result in some huge opportunities to buy multifamily properties at significant discounts to market value, especially since many of these properties aren't necessarily challenged from an occupancy or operations perspective, and the distress we're seeing is really just related to the misfinancing of these assets. And with current pricing levels at 15 to 20% below peak pricing levels in many markets across the country, investors who can either buy deals on an all-cash basis or put fresh conservative leverage on these properties are going to find some great opportunities in this sector over the next 1 to 2 years. Now, in addition to opportunities related to distress, the last big opportunity that I see in the very near term is related to the retail sector that we've talked about a lot on this channel recently, and this is getting involved with build-to-suit retail deals. Right now, retail supply growth and availability is at historic lows, meaning that developers aren't building new retail spaces and tenants don't have enough potential sites to choose from in many markets across the country. And this is creating huge opportunities for developers who can proactively seek out and partner with retailers, specifically those that often operate on a standalone basis, whether that's quick service restaurants, drugstores, convenience stores, or any other single-tenant occupier. These types of projects tend to be win-win scenarios for both the tenant and the developer, since the tenant gets a brand new building in the exact location they're looking for, and developers can significantly reduce their risk by having a tenant in tow. This also eliminates the guesswork associated with trying to figure out where sales of existing retail tenants are headed, or having to make renewal probability assumptions when acquiring an existing multi-tenant property, and this ultimately allows investors to go into a deal with a lease already in place, often with 10 years or more remaining in term. And with all signs pointing to rate hikes either slowing or even reversing at the end of this year, this could also make the next 12 to 18 months a great time to be a developer, with construction loans often including a floating interest rate component, and rate cuts in the future could actually make these deals even more profitable for the developer than they initially projected going in. If you're a strong relationship builder, you understand and enjoy the development and construction process, or you're a strong negotiator and you're willing and able to dig into commercial leases, doing these types of deals on your own, or looking for career opportunities in this space could be very lucrative paths to consider exploring. Now, obviously, a lot of these things are going to be dependent on where the economy and interest rates go in the short term, but with the current economic landscape as it is, these are 3 of the biggest opportunities that I see in this industry for investors and real estate professionals that are looking to get ahead and take advantage of these changes. And if you want to learn more about the real estate investment analysis process when pursuing your own deals, or you want to make sure you have the skills you'll need to land a job at a top real estate investment or development firm that's taking advantage of these opportunities right now, as always, make sure to check out our all-in-one membership training platform, Breaking the CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking a CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on the channel like this, make sure to hit the like button and let me know in the comments what you see as the biggest opportunity in the industry today. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.